Here's an uncomfortable truth. One day, you may wake up and realize you can no longer buy digital assets at all anymore. Not because the technology failed, but because access has been taken away. Exchanges have been rolled up, liquidity has vanished, and suddenly, the only way to own digital assets is through products built by Wall Street. The free market has never been the end game for these institutions. It was just the testing ground. And in this video, I'm going to break down the real playbook institutions running, why they never actually built the infrastructure for you to own assets directly, and how Tether could trigger a liquidity crisis. It clears the field, which guess what? Would give the banks what they need to roll it all up into structured products, which is a system they already control. And this is the story that nobody's telling you. And by the end, you'll understand why the window to direct ownership of digital assets is closing a lot faster than most people realize. So let's talk about what I think the real end game is. My name's Jake Claver. I'm the director of Digital Ascension Group, and we are the largest wealth manager for digital assets in the world. We have conversations with Goldman, Citi, BNY, Bank of America, you name it, we've talked to them, and we actually provide a way where people can own their digital assets inside institutional custody outright, not in omnibus accounts, not in a way where they're owed back to you or they can be taken from you, through Anchorage, who is our partner for institutional custody. So I'm having these conversations and I see what's happening. Exchanges, when people think about them, they think freedom, right? It's an on and off ramp. You can take your assets, put it in your cold wallet, which is direct ownership of the bearer asset. And that's how a lot of people think about this, right? If you're in crypto, I'm sure you've heard, not your keys, not your crypto. And it's true. But that is a radical way of owning something. It'd be like taking the stock certificates for your stocks from your broker and putting them in a safe in your house. People haven't done that since the 1920s and 1930s. Okay, so long time ago. But effectively, that's what you're doing with your digital assets. The same thing with gold. Most people own gold through an ETF or another structured product. Well, there's been, a theme here lately where people have realized that these paper derivatives are manipulated. And so there's been a trend where people have gone back to direct ownership of gold, but then you got to worry about insurance and vaulting and where it's held and all of these other things that you don't have to think about when it's institutionalized. So that's why I think most people would probably rather own it through a structured product. And the institutions haven't really built out the infrastructure for people to have direct access to these digital assets. They've been building the rails for settlement for themselves and not retail. Believe me, we've had a lot of frictions and frustration trying to get things to where we are today to actually be able to provide this for people. And when you have a Coinbase account, it's just like a bank. They have an omnibus structure. You have a tag number. There's one wallet. They hold all the assets in. They might have a couple different wallets where they hold stuff. But for the most part, they're commingled and they owe them back to you. If there's a bankruptcy, good luck. We saw this with Celsius, FTX, Voyager, and many others in the space that have been wound up over the years because of different situations where people have just been out in the cold. They didn't get their assets for years. If they got them, they got, far less than the value of what they were at the time, or what they were at the time and very different value than what they are today. But none of this is built for direct ownership. And I think there's a reason for that. I think over the long term, the whole play all along was to roll these into Wall Street under structured products. And that's the institutional blueprint for how this is going to work. We've already got ETFs. We've already got notes. We've already got derivatives. You've also got trusts that have gone public, like GBTC. And now we're getting more and more of these structured products. Now you've got DATs as well, these digital asset treasury companies, where you can invest in a company and you indirectly get exposure to the underlying asset. And those are the plays that Wall Street and institutions want to have happen, because now they're scraping fees off of all of those trades. And they don't have to worry about holding your assets. It's much easier for them to operate with an omnibus structure. They have full control of the situation, and they're making a spread, when you're trading those products as well. So they're making the fees, and you don't have to worry about all the other cumbersome stuff that goes along with, holding these assets on a cold wallet and the radical ownership that comes along with that. But at what cost, right? You're not going to be able to get direct ownership of these digital assets in the future if some of the scenarios we're going to talk about in this video actually play out. We've seen this in the past already, right? Like I talked about before with the gold ETFs, most people own derivatives. They can hold that in their qualified account, in their 401k or their IRA. It makes it very simple to get exposure to different asset classes if they are offered through institutions. And then they can manipulate the price and they can do some other stuff that, some people don't enjoy. But if it is all on the blockchain and it's immutable and we go to tokenization of a lot of this stuff and it's audited, a lot of that's going to go away anyway, which I think is great. It creates efficiencies and other things that I think are going to happen to make other things that I think will make markets much cleaner to participate in. But I do think this is the inevitable future. Digital assets are going to be packaged and not necessarily free flowing. Now, will you have the occasional ICO or something else comes out after the Clarity Act? Possibly. But it's probably going to be accredited investors or qualified purchasers that get access to that. A lot of this stuff where retail or non-accredited people have access to these things that are very high risk, it's very unusual. The CFTC, the SEC, and many other, regulatory bodies don't want non-accredited people to be able to participate in these markets. They deem that they are too risky. And a lot of the time they're right. There's a lot of people that I know that have lost a lot of money because they just weren't educated. They didn't understand, how to not get phished, or they invested in the wrong project, or they thought they were investing something that they weren't. And so because of that, I don't want to say that you need the amount of protections that some of these regulatory bodies want to impose, but I do think there needs to be some investor protections around this stuff. So let's talk about under what circumstances this could actually play out, where demand outpaces the access. If you watch some of my other videos, I believe there's a supply shock coming for XRP and potentially some of these other digital assets that now have ETFs issued for them. If you own the underlying asset, that's called having exposure to the bearer asset. And there's a finite supply of a lot of these digital assets. Now, some of them, they can mint more, and it depends on the tokenomic. But for a lot of the utility-driven assets, there's only a limited supply that's available on the market. And after we have institutional adoption of these assets, and people are using these protocols to settle value or secure infrastructure, or for a lot of the other applications that I think are going to come, a lot of that's just going to get eaten off the market. And there's not going to be a whole lot that people can even get access to unless, again, it's through these structured products. So, and the other piece is exchanges really can't scale to institutional adoption and volume. They don't have the distribution. And I do think that they're going to have some regulation put in, or they're, a broker dealer, or there's some oversight from these regulatory bodies. Whereas right now here in the US, they just kind of openly operate freely. And a lot of people can't even get access to perps or other things, products, and exchanges if you live in certain jurisdictions like New York because of the BIT license and, the things that you have to have in place. You also have other exchanges and different protocols, geofencing the US to keep, US investors out, even though they can use a VPN and broadcast and they get exposure anyway. But at the end of the day, scarcity is what's going to pull this market into a position where the institutions kind of corner it. And retail, I do think, is going to get cut out in a very large capacity. Now, obviously, you have your stock portfolio, and through structured products, you could get in there. But when it comes to the bearer asset, I don't know that they're going to be available, again, like we talked about at the beginning of this video. So a good comparison would be like prime real estate. You can't just buy in once institutions claim it. Once they're there, they're only selling to qualified purchasers or people on their Rolodex. They're not going to allow just your average person to get exposure to that, especially if it's a really good deal. And again, not that I agree with all of the regulations and what's in place or what qualifies as accredited or what isn't. I'm just talking through, what the regulations look like today and where I see the market going. So let's talk about what could cause the roll up of all of these exchanges by the institutions and investment banks and the ability for them to then take that liquidity or what's left of these assets and move it into those structured products. And that for me is Tether. We talk about the reverse carry trade and the dynamics that can play out there. Tether provides more than 70% of the liquidity across all of crypto. Almost all the exchanges globally outside the US use Tether as their liquidity source. And the majority of tokens are attached to Tether and exchangeable with Tether. So what happens if it depegs? Well, it's an instant liquidity crisis. We've seen it depeg a few times in the past and it's repegged quickly. But imagine a Terra Luna situation where people find out that they are not fully backed and whatever is on their balance sheet is a problem. Well, it'll become a self-fulfilling prophecy. People will run for the hills. They'll be divesting from Tether. They will have to, burn Tether very quickly in order to keep up with people selling off the Tether. And ends won't be able to divest quickly enough. We've talked to MasterCard. We've talked to a lot of the other large banks. they don't have any exposure to Tether. And that tells me that there's something there. There's a there there. And the ripple effect of that, no pun intended, would be that 99% of the exchanges and the altcoins would be wiped out overnight. And it's not just me saying this. Okay. We've got Brad Garlinghouse and many other large figures out there in the space talking about a situation where 99% of crypto goes to zero. And I think Tether is going to be what causes that. So let's talk about who would actually benefit in that situation. And it's not retail. Okay. It's going to be these large banks. They would be able to step in and acquire these exchanges for pennies on the dollar for what they're worth today. If they have, significant exposure to Tether, it'll end up creating a vacuum where these large banks could step in and roll these exchanges up into their infrastructure. And this is what I would call the great consolidation of crypto. On the other side of the crisis, exchanges would be bankrupt. They would be cheap and they would be desperate. And they would need these large institutions to come in and back them. And what a wonderful excuse. They would swoop in, make these acquisitions, and fold them into their existing financial plumbing and strip all the assets out and put them in the structured products, which fit neatly into what they already provide their customers. Some examples of, people that are already leaning into the space would be like the CME, the ICE, and the NASDAQ, who's just recently filed with the SEC to tokenize their stock market. But I think this will be more like the JP Morgans, the BNY Mellons, the Bank of America, Merrill Lynch, Charles Schwab, a lot of these wealth managers that are looking for a way to be able to provide these products to their clients and missing out on all the fees. I mean, how many wealth managers have turned people away over the past decade, telling them to stay out of crypto? It's too risky. Don't touch it. Bring your money back over here. And mainly because they really don't have a way to monetize it. And aside from that, they aren't educated on it. They don't understand what these assets are, the protocols do. They don't have a way to advise on it effectively. But we do, again, at Digital Wealth Partners. If you need financial advice on your digital assets, we would love to work with you. All you got to do is go to digitalwealthpartners.net and use the contact us form, fill that out, and we will be happy to help you navigate this space. So let's get back to it. What's the actual outcome here? Well, no more free markets is really what it comes down to. The institutions would be the gateways. They would be the ones with the access to the assets, and they would build the products that fit neatly within your already existing portfolio. And the direct ownership of the bearer asset itself, being able to move it off of exchanges to a cold wallet, I don't know that that's going to exist freely. There may still be a few, out there like Uphold or Kraken or a couple of these other large ones like Crypto.com that don't get consolidated. But I think for the most part, many of them are going to get rolled up. And again, the assets would be stripped out and used in these structured products. And I don't say this out of nowhere, okay? You need regulatory alignment, like we talked about with the SEC and the CFTC. We don't need to add an additional regulatory body like the VARA in Dubai, which is the Virtual Asset Regulatory Authority there. They have oversight on the digital assets, tokenized securities, and whatever else is tokenized there in Dubai and the UAE. We don't have that here in the US. We have guidance being put out by the SEC now. We have guidance being put out by the CFTC. And I don't know that we're going to get another regulatory body that sits over this asset class. And I might be wrong there. That may still happen. But I do think it's going to be oversight that the institutions are going to be under. And the ones that exist today don't have these assets unless this situation plays out. So at the end of the day, banks profit from custody and structured products, not open exchanges. And I know people want the freedom. You want a DEX, you want these protocols, you want access to peer-to-peer payments without a bottleneck in between that's scraping fees. But that's who sits in those spots today, are these institutions. And they are missing out on a ton of money because of this open source technology. And you can say that, the crypto bros are going to win out on this one. I just don't see it happening. I think there's too many people with their finger in the pie that want a piece, and they've figured out a way to do this and make sure that they get their cut. And this has happened before. Like I talked about with gold, there's been other industries that, people were trading on the side or other things were happening. And when it becomes large enough, the institutions want their cut, and they will come in and they will tame those disruptive asset classes by offering derivatives above them. This actually happened for crypto early on at the top of the bull run in 2017 for Bitcoin when they rolled out the CME. You can pinpoint the day that they put out the futures market. That is the day that Bitcoin turned over in 2017. So what's the effect on retail with all this? Well, you're basically going to be owning ETF shares. And many of you hold stuff on exchanges today and you really don't own the assets even then. You are owed those assets back by the exchange. Just like a bank owes you the money back. When you give it to them, you are a creditor of their institution. Unless you take the cash out of the bank and put it in your wallet, that's the only time you own it. But again, you don't get the assurances that an institution would provide. I'm more of a have your cake and eat it too type guy, and that's why we built what we built. But I don't see these other institutions doing it. They're not creating ways where retail can hold the bearer asset. Now, will there be situations for qualified purchasers or accredited investors? Yeah, there's some larger people right now that provide those services at scale for people that are holding larger amounts. But for retail, absolutely not. I think it's absolutely going to be through structured products for retail to be able to get exposure to this stuff. And if they do this, banks will control the redemptions, control the liquidity, and they'll control the collateral. And you'll hold claims to the digital assets, not the digital assets themselves. And this can also be beneficial, right? So I don't want to paint this in the worst light ever. As an example, let's say you wanted to borrow against your Bitcoin today. You're going to be looking at somewhere north of 9%. I've seen stuff a little bit lower than that now that we've got, rates coming down from the Fed. But for the most part, you're above 9% if you're borrowing against your Bitcoin directly. But if you're holding one of these ETFs, you're actually going to get a lower interest rate if you margin that ETF than you would borrowing against the bearer asset itself, and potentially an even higher LTV. Just depends on what the risk they're willing to underwrite is. So again, you don't own it directly, but you also don't have to worry about it. You own a paper derivative, and you actually might get better access to liquidity and distributions and whatever other things you're looking for without having to deal with all of the direct ownership stuff, like again, the cold wallet and learning how to use crypto and the exchanges and the blockchain, passwords, all the stuff that people have to deal with today, and why scammers are so prevalent in the space. Retail investors think they are the end game, but at the end of the day, I don't think so. I think they're going to end up holding paper promises. And that's, again, not the worst thing in the world. For the masses, most people don't even care to own gold directly or silver directly. They would rather own it through a paper product or a derivative. And I think the same will end up being true for these digital assets as well. So like I talked about, I think this is the actual end game. Envision a world where 99% of the tokens are gone and only a handful of banks approved digital assets remain. This would be, Bitcoin, Ethereum, XRP, XLM, HBAR, Algorand, Hash, and I could go on and on. Ondo, there's many others out there that I do think will stick around, probably somewhere between 70 and 90 projects that will have real world utility and enough liquidity outside of Tether that they do float, they come back up after everything else sinks. And again, most people are just going to get access to these on the other side once they're institutionalized. Many family offices that we talked to today are still very skeptical of this space. They don't want to deal with how cumbersome it is to own the direct asset. They would much, much rather own it through an ETF or a structured product inside their portfolio, which would be much easier to report on as well. So over time, I do think that these exchanges and the free access and ability to withdraw your assets off of an exchange to a cold wallet may end up going away. Not that they won't still exist, but most people won't operate that way. It'll become, Wall Street 2.0, basically. And I will say, Robinhood has already throttled this. Many people that we work with and I've talked to, Robinhood throttles how much you can remove off of the platform on a regular basis. So if you have your assets there, just be aware of that. I think they're kind of, more of a stockbroker, obviously, than they are the crypto side, but they've accepted that as well. And they've done it the way that I think it's going to be done. They have omnibus accounts. They're not structuring this on your behalf or FBO accounts. And again, they want to keep the assets inside their infrastructure and not let them out. So how do you stay ahead of the game? How do you take advantage of this? Well, if you're owning digital assets today and you have direct exposure, you're way ahead of the rest of retail. We have the best custodial solution outside of an exchange, really even better than an exchange with our partnership with Anchorage. Hopefully you've got it structured inside of some type of wrapper or company or trust. It could be inside of an IRA. It could be inside of an LLC. It could be inside of a trust. But you're going to get those creditor protections if you've done this correctly. And you're going to have a lot of benefits to holding them over the long term. And you've done it. You've got here. You're here before they shut the door on your ability to buy these digital assets and own them outright. Most people, again, will end up with issued assets that have clawback provisions or can be frozen and not be able to hold the bearer asset on some of these networks that really do allow them to directly have access to peer-to-peer payments or provide liquidity to the inevitable pools that will exist for these institutions later. And really what I think are the golden goose of crypto. If you're owning these digital assets now, you have the bearer asset, you're going to be able to participate in ways that only institutions are able to in the future. I think we're in the final window here. And I think institutions never wanted you to actually own digital assets outright. Tether or another crisis will provide their excuse to swoop in and roll these exchanges up, strip the assets out, and bring to market all these structured products where they make the money. Banks will consolidate everything and control the access to these assets. You still have time, and you still have time right now to get access to this stuff. But when the door closes, I think it's going to close for good. So let me know what you think. Am I crazy? Is all this just hogwash and none of this is going to happen? Tether's going to be around in perpetuity. You know, there's not going to be another situation where these exchanges get rolled up. We're just going to have decentralized freedom forever. Or do you agree with me? Do you think this has been the plan the whole time? Let me know in the comments below. And if you found value in this, please like, subscribe. We'll see you guys on the next one.